you know who it is. This is Austin, and this is the Austin Smith Real Estate Podcast, where we talk about real estate and we talk about lifestyle. Today's guest is here to help us keep more money in our pockets. It's not about what you make. It's not about what you spend, to a certain extent, but what you keep. And today's guest is going to be discussing the tax strategies that you can implement right away for this tax season that'll help you save a ton of money. And he's absolutely amazing. So we'll get into that. A little bit of housekeeping before the show. Be sure to log on to austinsmithrealestate.com and subscribe, so that way you can get the podcasts, the articles, the blogs, the content, tips, strategies sent straight to you on release day. And if you have benefited or received some value by listening to the show, please log on to iTunes, leave me a rating and review. Let's continue to share this message. Let's continue to share this sugar. So, without further ado, let's get into the show. Because Jay-Z said it himself.
Who deserves the medal of freedom is my accountant. He been hula hooping through loopholes, working round shit.
What's going on, everybody? Today on the Austin Smith Real Estate Podcast, I definitely wanted to switch up the shows a little bit. And one thing that people often miss when it comes down just to finances in general is they tend to focus on the number that's coming in and not the number that's coming out, which is why we're always a good portion of the time striving to make higher incomes, higher salaries, things like that. And it's always great to be mindful of one, what's coming out, and two, what can you keep? And that's what today's episode is about. And today's guest, he's been doing taxes since he was 16. So you can imagine the boatloads of experience that he has. And he's going to be coming on today to talk to us about tax strategies that keep money in your pocket for you to use at your disposal. Ladies and gentlemen, I want to introduce you to Carlos Fraser. Carlos, thank you for taking the time to come on the show, brother.
Thank you very much. Thanks for the invitation. I truly appreciate it.
Nah, absolutely. And as my accountant, I appreciate your work, and now it's crazy to see how different strategies when put in place, and when you know certain areas that you can be saving money on, it really is extremely helpful. And I would love to bring that out to those listeners. So let's jump into this. How did you even get into the business?
Oh, man, it was a funny story. I started at 16. My father's a CPA, a certified public accountant, and he was working at the IRS at the time. And I didn't want to do accounting. I actually wanted to be a neuroscientist. I got into a Macy's program at UMDMJ, which is now Rutgers. And I was in the program, and then one day we had to go look at cadavers. I didn't know what a cadaver is, and I realized a cadaver is a dead body. And once they explained to me that I have to deal with dead bodies and all those other things, which I didn't even think about at that time, I came back home and I said, Daddy, I'm ready to do this tax thing. And then I just been doing that ever since. He showed me the ropes from the ground level, receipts and profit and loss statements. I went to Hampton University. I graduated with a major in accounting. Then after that, I worked at Polo Ralph Lauren doing payroll taxes. I was there for a while. And then after that, I worked at a tax law firm called J.H. Cohen, which is now I think it's Cohen Resnick, which I was doing tax resolution for high net worth clients. And then I left and worked at a non-for-profit as a CFO for a while. Then I came to work with my father at Fraser CPA Tax Co. Here in Maplewood. So, I've been doing taxes just all my life. I love it. I think about it when I'm in the shower. I think about it when I'm sleeping, when I wake up. It's just something that I really love.
Is it the numbers, like in the passion for the numbers, or is it just like being able to have that ability to, take an income statement and be like, no, you're not taking money here, 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 and like, and getting the rush over that?
Yeah, good question. No, it's not the numbers. Actually, I am not the greatest in math. I need a calculator for every single thing. I think the reason I like tax accounting is basically law and numbers. So law is based on interpretation. So I like reading the law and interpreting it to the client. Essentially, it allows me to print money because sometimes a client would come in with a preconceived notion of what their refund is, and we could bring it higher just by speaking to them. I had one client talking to me yesterday, and he said, I got in a car accident. Unfortunately, at that time I didn't have insurance. I had to pay like $5,000. I was like, whoa, that's a tax write-off. And he just didn't know it. So, the tax law is so expanded. It's almost 3,000 laws. So being able to match the law with the person is what I really like.
That's awesome. I've never would have even thought about taxes the way that you kind of explained it, and I like the phrase that you used. Was it creating money or creating checks?
Yeah, printing money. That's what we like to say. We print money. So as long as you have the backup and it matches the tax law, the government will give you that money back or some form of credit or rebate. And that's really what it really breaks down to.
So just like an agent who's playing matchmaker between buyer and seller, you are playing kind of matchmaker with the personality the personality of the client and whatever tax strategy that they can use to their advantage to print money.
Definitely. I always ask the client, let me know what happened to you last year. I mean, usually I would like to know it in the year, but I ask them what happened to you last year, and I just listen. I don't really talk that much. I just listen, and I write my notes. Then after they're done, I go into, okay, this is deductible, that's not deductible. And then after a while, they start to see, oh, this is what I can do moving forward. And that's what I like, because everybody's a fingerprint. Everybody's different.
That's awesome, man. So let's talk about real estate specifically and property specifically. If somebody was looking at like a pamphlet of the benefits of home ownership and things like that, usually you can always count on tax advantage being one of the pros in that situation. But we all don't really understand the nitty-gritty of those strategies that you can actually implement. So starting with, just regular property, even for a single family, and not an investment property per se, but single family, give us just the benefits of being a homeowner and the tax savings that they can see.
Yeah, so that's a really good question. In the post-Trump era, there was a lot of tax savings with the home ownership. Now that we're in the Trump era, that tax savings is somewhat diluted. What I tell clients is I tell them, hey, listen, open up your hand, both hands. And in your left hand, rental property, in your right hand, primary residence. On the right hand, as a primary resident, the only thing that you can deduct is your mortgage interest and your property taxes, and that's really it for right now. There is an energy credit if you make any improvements to your home to make it more energy efficient, exterior windows, exterior doors, caulking installation, solar panels, and so on and so forth. But the low-level things is mortgage interest and taxes.
And not depreciation?
No, depreciation is not deductible on the primary residence. In your left hand on a rental property, it is. But in your right hand, it is not. And most people are righties, and that's why I say the right hand, because most people sometimes buy a primary residence. So the only thing that's deductible for a primary residence is the mortgage interest and the taxes. And now that Trump has put a cap on property taxes of $10,000, what that means is if your income tax and your property tax are over $10,000, you may not get a benefit for your property taxes. So take, for example, if you're a high net individual and you work in New York and your state taxes to the city of New York is $10,000 and you have a primary residence and your property taxes are $10,000, you do not get the benefit of the property taxes on the federal return because there's a cap of $10,000, and the first $10,000 is usually the state taxes you pay in your applicable state. If you are in a state that doesn't have any taxes, kudos to you. It goes towards your property taxes. But that is the plain kind of gist of it. In addition to that, there are standard deductions. And what a standard deduction is the government will give you a deduction, but you can go higher than that if you have additional expenses. But now that the property tax is capped at 10 and your mortgage interest may not be higher than the standard deduction, because the standard deduction for a married person is $24,000. So to get over that threshold is kind of hard. So right now in the Trump era, primary residence may not give you the bang for your buck as it was in the post-Trump era. So what you're really trying to do is try to build as much equity in your home as humanly possible. So when you do sell it, there's still a tax rule that allows you to sell your primary residence and exclude up to $500,000 worth of the gain on the sale if you're married and $250,000 if you're single. So as a primary resident, you're kind of put into a box in this Trump era.
Interesting. There was a couple of things that I wanted to talk about. When you mentioned just the Trump era taxes being capped at 10, taxes being capped at 10, what's the, for the listeners, what's the adverse effect of that? Like, what's the negative effect of that? Is it the simple fact that people who would normally write those taxes off can't, and now they've lost a piece of what they could be saving and now have to pay taxes on that?
That is exactly what it is. You hit it right on the dot. And that's what happened this year during the tax season, because this was the first time people really had to file taxes under the Trump era. If you were a single individual and you were making a high net worth, let's say $100,000 plus, and you had a primary residence, you would have saw that your refund would have went down because you probably wouldn't have gotten the same benefits that you received prior. And it kind of puts you in a box. It's unfortunate. And the reason, well, no one really knows the exact reason of the $10,000 cap, but what we have been thinking about in the tax community is that the Trump administration would like to make sure that people are purchasing properties not for the tax savings, but to purchase a property that, one, they can afford, and two, that they're really going to live in for a long period of time to build equity. What we've seen in the past is under the prior laws, people would really buy homes for the tax savings in it and usually won't stay in that home for a long period of time and move out. So what the Trump administration, which people assume is trying to do, is, one, make sure that buyers are coming in, are more qualified because they know they're not going to get that much of the tax savings. So it's really buying a house for the equity. And two, making sure that if you are buying this house, you may have more, you may stay in it a little bit longer rather than jumping and leaving ship.
Interesting. Because that was, okay, so you've already answered my question. What was the goal of, of the government putting that cap at 10K? And you answered it perfectly. The other thing that I wanted to just double check on is the tax savings when it's your primary residence, $250,000 if you're single, $500,000 if you're married. Two questions on that. One is that, can you do that at each and every primary house, or is there a certain limit?
Good question. So there is a 2 out of 5 year rule. So you have to live in the house for 2 out of the prior 5 years to qualify for that. So with tax law, which I like, there's an exemption to the exemption to the exemption. So the rule is you had to live in the property for 2 years out of the past 5 years. You can still get the exclusion if you had to move involuntarily due to health or job, or you could get a partial exclusion if you don't live in the house for the whole 2 years. They'll create a ratio based on the number of years you did live in the house to get a ratio amount of that 250. So hypothetically, if you lived in the house for a year and 6 months, you would get 1 year and 6 months divided over 2 years, whatever that ratio would equate to, multiplied by that. So, I mean, there is an opportunity to do that. And this law was put into place after Reagan. Was before Reagan, what used to happen is you could have sold the house and any gain that you had, as long as you bought a replacement home within a certain period of time, you paid no taxes. But when Reagan left office, the new president that came in changed that law, and it's been in existence ever since.
Gotcha. And just to be clear, you have to at least own the property for 5 years. You don't have to live in it all 5 years, but you have to at least own it for 5 years in order to be able to get that tax break.
No, you have to. So you have to live in it in 2 years out of the 5 years. And the reason they say that is because, in the past 5 years, you could live in it 1 year, move out, make it a second home, then move back in. But as long as you have 2 years under your belt in the past 5 years of living in it, because you could be an owner, but you're not necessarily living in it. You have to live in it.
Okay, so it's in the past 5 years. Okay, so you don't have to own it for 5 years. It just has to be within the past 5 years. Awesome.
In the past 5 years. So if you lived in the house for 2 years, let's say 2017 and 18, and you sold it in 18, you qualify because you lived in it for 2 years. They just say the 5 years, giving you more of a look back period. If you had to leave the house for some odd reason, if there was a fire in the house or national disaster and you had to leave, it doesn't supersede the amount of living.
Gotcha. Okay. And then the second part of the question regarding, just the tax savings when it comes down to capital gains. With capital gains, how do you calculate what the actual capital gain is? Is it just sales price versus what you owe?
Good question. No. So there's a lot of ingredients into the soup called capital gains.
It is a whole other beast. And I remember we were talking about it, and it's nitty gritty. But go ahead. How do you calculate capital gain?
Yeah. So when you calculate capital gains, first you take the amount that you purchased the property for, and then you add on any improvements that you made to that said property, and then subtract it by the sale price. Whatever that gain is, you then have to ask yourself, is it long-term or short-term? Short-term gain defaults to whatever your tax bracket is. So if you fall into the 25% tax bracket, you pay 25%. And short-term is less than a year and a day. And long-term is a year and a day. And long-term, there's 3 thresholds. There's a 0% capital gain tax rate, 15%, and then 20%. And that 0, 15, 20 is based on your filing status on your income. So let's take, for example, if you are a single person and you make around $38,000 and you sell a property and it's a long term, you pay no capital gains tax because a single person who makes under $38,000 taxable income falls into the 0% tax bracket. So once again, there's 3 things you have to worry about. What is your basis? And your basis is the amount you purchased the property for plus the improvements. Is it short-term or long-term? And what is your filing status and your income? With those 3 elements, it creates what your capital gain tax would be.
Okay, awesome. So in regards to, because flipping as a business, right, they put themselves in this position all the time. Short-term, maybe they might have had plans for it to be a short-term capital gain, and they're running their numbers that way, but then the project winds up taking more than the year and the day,
Correct.
and then now they're in a totally different, situation. For people that are, with the capital gains, is there a way to, are there any like deductions when it comes down to capital gains? Like, are you able to say, well, I had to do a, $50,000 Reno job, and, it cost me, I had to use my car to go to use gas to go to Home Depot. Can you write that off? Because that, obviously that is a write-off in certain cases, but is it when you're dealing with capital gains?
Yes, that's a very good question. So some people do add that into their rehab costs, and sometimes they don't. And the reason why is that most times when people flip, they may already have an entity that they're flipping under, and they may want to take those expenses under the entity. And the reason why is, like you said before, sometimes a project is not going to finish in this year. So are you going to take your telephone expense, the rent that you pay in your business location, and put it onto the capital gains? More than likely not. You're probably going to expense it out under the name of the business because it happened in that year. In most cases, most people take the cost of the property and any true rehab cost that you incurred in that applicable project to reduce the capital gains as much as possible. And a lot of people, the more savvy individuals, they're tracking it. Every time they're doing something, they're either putting it in their Excel sheet or whatever have you, and they're calculating, this is the gain, to see where it's at. But to answer your question more specifically, no, you really don't put like the mileage and telephone in there. You usually would put that under the name of the business. However, incidentals like the utilities at the property or the insurance at the property, you can't put in the calculation of the capital gain because it's more related to the project.
Gotcha. Oh, okay. So that makes sense. So wow, okay. So you're actually there are some strategies where you're able to roll in certain costs that you incurred during the renovation aspect of it and use that, factoring that in to lower, to make that expense or that all-in number higher. So that way your capital gains total result is much lower.
Correct.
That's pretty interesting. Okay. Awesome. So what is, for somebody over the course of the next, it's May now, so over the course of the next 6 to 7 months, what are some things, for example, people either with investment properties looking to purchase their their first investment properties, what are some things that they can start putting in their minds in order to set them up for success when it comes down to, next tax season when they're filing for this year?
Yeah, I would get a team together. The reason I say that is because after December 31st, all bets are off. It's the tax return is, well, in our business we call it post-mortem. It's dead. But before that time, from now to December 31st, you should meet with your team. You should meet with your accountant. You should meet with your mortgage broker. You should meet with your real estate agent, and even meet with your potential lawyer just to get an idea of what's going on, especially if you're new to this and you're pretty much green. Because what's going to happen is your realtor and your mortgage broker will kind of pre-approve you to see what you can buy. Your accountant will kind of let you know what tax benefits you can get from this said investment, and if it's something that you want to do. And of course, the lawyer will help you close on it. So really just getting education on who you are as a buyer and what you want to do and what would the end result be. And the reason I say that is the perfect example that happens most times. High net worth individuals go out and they buy property. They come into my office, they make $150,000 plus. They are so happy they bought a rental property, and they're saying, listen, I poured almost $100,000 into this property. I'm ready for my refund button. Where is it? And I tell them there is no refund button. And they look at me kind of crazy, like, what are you talking about? I have all these losses. In the IRS, there's a law called passive activity. If your income is over $150,000 and more than 50% of your time is directed to non-real estate activities, you can't take the loss, especially if it's a buy and hold, like you're renting out the property. Because what the IRS says is $150,000 is too much money, and we are not allowing you to take the losses from a passive activity. And a passive activity is an activity that is making money or losing money without you being around. And they don't know that. And once they come in, they realize they're like, wow, I wish I knew that. I probably wouldn't have put all this money in. And it goes back to really sitting down with the professionals beforehand to see what it is. Now, in most cases, they still would have bought the property, but they would have had the knowledge when they came in there knowing that, okay, I'm not going to get these losses. These losses will either eat up the rental income that I get or eat up the rental income in the future, or if I do sell it, the losses will be released based on the IRS tax law.
Interesting, because, yeah, you can do write-offs, because I'm actually upgrading a bathroom at one of my properties, and that can be a write-off.
Correct.
And it's when your net income is, and remind me, is it the net income of the property or net of the individual? So net individual,
their wages. Correct. And essentially, it's like their wages. If their wages is $150,000 or more, they don't get the benefit of the loss on the property, unfortunately, if they're not considered a real estate professional.
Now, is that so 150? Now, when you say wage, you're not talking about like just an employee, like you're talking about just income in general.
Yeah, it's usually income in general. So it's either your wages or sale of stock, anything that is going to make your income more than $150,000. If you took a distribution from your 401k or IRA, unemployment, all those totaled up, if they are more than $150,000, you basically wean yourself off of taking any losses from a rental property. Now, if you buy it and flip it and you get a loss, doesn't matter with the income. But if you are buying and holding it and renting it out and accrued a loss, that loss is unfortunately not deductible in the applicable tax year if your income goes above that $150,000 threshold.
Gotcha. And last question on that $150,000 threshold, is that based off of your 1099 or your W-2, when that comes
It could come from any source. It could come from your W-2s. It could come from a net income from a business. Let's say if you sell cell phones and your net income is $175,000 after everything's said or done, that can hold you down. If you took money out of retirement and it totaled more than $150,000, that's hold you down. So it could come from any source.
So I was just okay. So right. So say if 1099 wise, I 150,000, but then after the write-offs and the expenses and things like that, your adjusted net income is at 90,000. Does that threshold still count in that case?
Yes, it does in that case. So to get into the nitty-gritty. But the threshold is somewhat reduced because now what is going to happen is the IRS takes a $150,000, they subtract it by your $90,000 and divide it by 2, and whatever that number is the amount of losses that you can take in that applicable year. So as you can see, and like I always say, there's so many gamuts to this tax law. You have to jump through so many fiery hoops to get to the end that it is in your best interest to sit down with your tax professional and sit down with other advisors, because once December 31st comes, you can't make any changes. So if you know this, let's say hypothetically you knew this, you say, you know what, I'm going to make sure I have more expenses so I can reduce my taxable income as much as possible. I have this insurance I have to pay for my business that's due in January. I'm going to pay it in December because it'll bring me under that threshold. So the this checks and balances, unfortunately, with this tax law, and you do not want to wait till the year is over to make these decisions, because in most cases you can't do anything.
Well, that's exactly why you're my accountant. But aside from that, the last question just before we start to get into the core four, why isn't this taught? And the reason why I ask why isn't this taught is because I don't think I would have been as much of a learner of tax strategies and asking questions. I wouldn't be so engaged if I wasn't in business and trying to find, and trying to find ways to keep more money in my pocket. But why isn't it kind of promoted often? It's more looked at a negative, rightfully so. But,
yeah.
There's so many ways that you can save money. And Jay-Z kind of, I don't want to say bragged, but he's very adamant and makes sure that people know like that his accountant has is doing great work with exploiting those opportunities.
Yeah. So you know what? Like I said before, the tax law has over 3,000 laws, and that's not even counting the administrative laws and practice and procedure. So sometimes most accountants may not even know. And two, you really have to go and let your tax professional and accountant know. Because if they are a good tax professional and accountant, they're busy. And if they're busy, unfortunately, they're not thinking about you. You have to think about yourself. Come into the office and say, hey, this is what's going on. This is what I want to do in the future. This is what's going on now. What can we do to save money? And then they'll create those strategies for you. Just in like any business, you kind of have to go put your first foot forward, and that in finding a qualified individual and being able to communicate with that person is in your best interest. Because I am sure that Jay-Z's accountant just doesn't, think about these things. Jay-Z tells them, this is what I want to do. What do you think? And the accountant says, well, yeah, you can do this, but this is what's going to happen. And it gives him what we call power. Because if I give someone options, that gives them power.
Yeah. I mean, you hit it on the head. And that's, when we met, I said, listen, this is what we're trying to do. I am trying to write off, but I'm not trying to write off as much because here's where I'm trying to go with it.
Correct.
X, Y, and Z. And you kind of matched up the desires and the personality. So that's awesome, and it's an amazing job of how you kind of play matchmaker with those opportunities. Okay, as we start our descent here, this has been a wealth of knowledge and a wealth of just gold. Is there, before we get into the core four, which are the 4 questions that I ask each and every guest on the Austin Smith Real Estate Podcast, is there anything that you want to let the listeners know, either a quick tip or something to look out for? You've been, I wish I can tap into your expertise all day.
Yeah, I know. It's so much to talk about. But one thing I would definitely tell people is that we live in different times. We live in a time where if you do not think about yourself and if you do not be proactive in what you have to do, you're going to be left behind. The new tax laws are there to give away money to people who, unfortunately, aren't able to see the opportunities. It is one of the most drastic tax law changes since the creation of tax law in 1913. And most people are unaware of how many things are changing. If you are a W-2 person, I would tell you, think about creating some form of business. I don't even care if you lose some money on the side. It is in your best interest to create something on the side. It doesn't have to be an LLC. You could do it as a sole proprietorship. If you like making soap, make soap and try to sell it. Because we live in a time now that a person in the basement can sell more soap than someone that has a brick and mortar outside. And we have to take advantage of that. especially in the African American community. We are highly consumable people, and we buy. We tend not to save. So it is in our best interest to make sure not only do we save in these times, but if we do have something to sell, goods or services, try it. What can happen? You don't make it, and then you just keep on going.
Right. All right. Excellent point. Awesome. Okay. Call for question number 1, which I think we might have answered already. But what is your favorite aspect about accounting?
My favorite aspect about accounting is that I always say I could print money. I could, in most cases,
Right.
Anytime someone comes in, I could print more money. But I love to help people. I love to educate people. I love to make things in layman terms so you can understand it, because the more my clients help themselves, the more the work becomes easier for me because they're coming in nice and clean. So I would say the thing I like about it is just helping people. It's really not about the money or anything. I really like helping people.
Awesome, man. Awesome. Question number 2, favorite business or personal development book?
I would say my favorite book is I think it's Andrew Carnegie, How to Talk and Be Liked. I forgot the
How to Win Friends and Influence People.
Yeah. And, it sounds real cornball. There's some square type
it's
stuff,
amazing.
but
It's amazing.
it's amazing. It's a very amazing book. And now that we live in the technology that we have, you could go onto YouTube and listen to it. And I listen to it at least once a month. And it's gold.
Just learn how to speak to people, learn how to, say what you want to say, but making sure that the person understands it correctly, because it's so, it's not even your fault, but each individual has their own personality and they have their own assumptions about how they take in communication. And it's so easy for one person with the best intention to say something, and then the other person just take it completely wrong, that it doesn't work when you're trying to build a business, when you're trying to build a team, or anything that you're trying to get somebody to do. Those things help, and vice versa, the same way that you would receive the communication. So yes, excellent book. Okay, question number 3, fun things that you like to do in your spare time.
Oh, wow. Actually, I used to break dance, so I don't do that anymore, but I like
Nice.
to draw. Yeah, I like to draw. I'm really good with graffiti. I like to do stuff like that. So when I'm out, if you see me on the street, you wouldn't even think I'm a tax accountant, because my fly is on 110, to be honest.
Word, I'm all for it. As you print money, man, listen.
Yes, I print money, right?
As I print money. Question number 4, final question. Carlos, where can people find you at?
The company name is Taxco, which is TAXKO. Our website is taxco.co, which is TAXKO.co, not com, .co. And the phone number is on the website. And I basically almost live in the office. We have other offices in Newark and Bloomfield. And be on the lookout for taxco.gov. That's tax.gov. We are creating a proprietary website that will pre-qualify anyone that owes the IRS personal, business, or payroll taxes in 10 minutes or less for all the IRS programs.
Awesome, man. Carlos, this was a wealth of knowledge. It was gold. If, for people in business, for people that are just looking to, this is just financial literacy, and you don't have to understand everything. That's the beauty of it.
Correct.
You can go to the professional the same way that you might work on your craft 80, 90, 100 hours a week. There are professionals that are working on their craft, the same amount. And, but just as long as you know that, understanding taxes, understanding the tax laws, understand what you can do in order to keep more of your hard-earned money in your pocket to then use that to go invest with, because the money's going to work harder than you.
Correct.
Then, these are the opportunities where, you are able to build wealth. This is where you're really able to make an impact on your finances. And, yes, it was amazing. Carlos, thank you so much, brother, for coming on the show today.
No problem, man. You guys have a great day. I know it's a lot of information. May have exploded a couple of heads, but, we try to give it to you as digestible as possible.
Yeah, for the episode, if people listen to it 2 or 3 times, they at least know what question to ask, so they can
Correct.
and how to ask that question, so they can get the answer that they're looking for, and so on and so forth. Here we go. Can't wait to we have to have another meeting just to make sure that I'm on the on the right track on what I'm trying to do, and we'll keep the ball rolling.
All right, sounds good.
Thank you, Carlos.
Thank you.